Welcome traders and investors. If you ever wondered why the dream of stock market riches seems out of reach, you're not alone. Today we're going to be diving into the murky waters of the stock market to uncover why 99% of traders fail. The stock market, shocking truth behind a stock market riches, and how close you can be to those riches. Good morning or evening, ladies and gentlemen. Hope you're having a wonderful start to your day. Now, we've all heard the story, seen the headlines, maybe even dreamed of quitting your job to live off the market's bounty. But here's the truth: from every success story, there are countless tales of failure. You only really hear about the successful ones because they get to write the history books. You don't hear from the ones that didn't make it. Why? Well, simply put it, they make three critical mistakes that most traders make over their entire careers, and they never necessarily learn from it. Today, we're going to be going over and exposing those silent killers in your trading account, and also diving into why you need to critically avoid them, how you can avoid them, and even I'm going to throw out at the end of the video a couple of things you need to do in order to maximize your return, and they're only going to take 30 minutes of your time each. Not a lot, right? How much do you guys spend scrolling on your phone, looking at TikTok, looking at Instagram? You can spend 30 minutes improving your life, and who knows, it may change your life for forever. It sure did mine. So my name is Michael. I do all the technical analysis on this channel with my best friend. We created this channel in order to basically break the mold of the market and also break the mold of the financial channels. We don't sell you a course. We don't want your money. Simply, we want you to join the Discord, come chat with us, be a part of the streams that we host every Monday. We do a market open stream right on Sunday night into Monday, and it's really fun. You get to be the streamer. You get to interact with us live on chat, not just voice and not just chat in the stream, but chat live in the Discord, and we record it and stream it live to YouTube. So really fun interacting. So if you're ready to understand the real reason behind why 99% of traders fail, and more importantly, how you can join the elite 1% who've succeeded, then buckle up. This isn't just information, it's a roadmap to mastering the stock market. And we're going to start with number one. So number one is emotion. The worst enemy in the stock market by far, if you ask any single trader, it's the 6 inches from your left ear to your right ear. This thing in between has caused more traders to blow up than anything in history. Not a single thing. Throw in the comment section down below if you think you can find something that's worse than the 6 inches between your left and right ear. Your brain literally overcomplicates things to no end and has led to more downfalls in the stock market than anything. Haven't you heard Warren Buffett's strategy? Keep it simple, stupid. It is literally that simple. Now, if you look at the chart that you have on screen here, there's a lot going on. I personally use this to get general direction, but I really want to show you what the simplest chart you can actually attain so much about, and that is simply this. It is a simple bar chart that you can look and establish very easy patterns. You don't need every single indicator. More and more times I see traders basically having billions and billions of indicators. It's a game of almost Russian roulette, how many indicators I can fit on a damn screen. Guys, if you have more than 2 indicators on your screen, and I know I'm being a little hypocritical considering I just said I use this. Now, the bottom I kind of just used as a reference. It's mainly the above. And if you guys would like to know what these indicators are, Lux Algo, link in the description below. I have been a lifetime member of them. You can get a monthly subscription from them. They're not endorsing this channel. They don't sponsor this channel. I just thoroughly like using their content. So make sure you check it out. Link in the description below, along with the Discord. And while you guys are down there, if you wouldn't mind hitting the subscribe button and have bell notifications on so you know we're going to be streaming. We're actually going to have the CPI stream this week, so make sure you guys don't miss it out. I also dropped the weekend deep dive video where we're going to discuss everything that we're going to talk in this video in more detail and actually give you examples of how we get these levels that we talk about, right? And I'm going to actually show you some of these levels in just a moment. So make sure you guys are subscribed to the channel so you know when those videos are coming out, and we explain a lot more than we can in this 10-minute video that I'm making today. So again, going back to this is why it's so important to just look at simplicity, because on the screen here we have the S&P 500. If you guys were playing around like I was, you basically were thinking, oh, the stock market is going to crash, it's a triple top, right? All this crap that's out there, right? Everyone's posting videos of market recessions. Everyone's posting videos of housing crashes. How much emotion has that drawn up in you? Because it's clickbait, right? Even the title of this video, 99% of traders fail, it's designed to be clickbait to play on your emotion. You need to separate that when you come to trading. You have to look at cold, hard facts, and that's why number 3 is going to be the most important out of everything. But simply put, this is what I use to simplify trading the simplest. 50-day moving average, 200-day moving average, the weekly levels. That's it. I don't make it dang complicated. I have Lexalgo to give me an edge because in this game, it's how much of an edge you can have. But you don't need a huge edge in order to make money. You don't have to make money consistently in order to be super successful. You can have bigger plays that basically level out to consistent gains over time. It's the drive of consistency, and emotion makes it so dang hard to do that. So that is why emotion, you need to remove it. You basically have to think almost, Nassim Taleb describes it in Black Swan. If you haven't read that book, highly recommend, and we'll also give you a couple more recommendations towards the end of the video. But that is literally, he talks about how the human emotion and the human psyche plays into everything. And you really wouldn't know that until you actually went and read his book. Highly recommend. I will link in the description below to the Amazon affiliate link so you guys can check that out. But again, that is where you really need to understand your emotion when you're getting. I have times, right? And every trader will, if you say you don't, you're full of crap, so that you don't just rage on the markets. There's some days I find myself just mashing the buy button and I go back and I'm like, you idiot, like you complete idiot. Why are you hitting the buy button? Like today, I was hitting the buy button a lot, but I was doing it calculated. And that's why number 3 is going to be so impactful to you guys. And subsequently, we see the market actually did a pretty decent day. We were down a bit, but again, you held fast. You didn't let emotion take hold, and it was a pretty profitable day. Now, as you can see on the screen, I have my positions that I have, right? I have a couple red positions. I have a couple green positions, but that's because, number 1, when you play options, some brokerages take the last bid pip, and sometimes that bid disappears. So that's why you see some of these positions aren't actually accurate. The Microsoft position's not down $43, but it's more like down $10. But I initiate all these positions and I'm playing with things. I'm not afraid to see red. Normally traders will see red and they'll go horribly wrong. On futures day, I made $150 just in a matter of 5 minutes. It was a simple trade that I saw coming. That consistency is what I'm after, as I drive to that consistency. How consistent? Question. Can you go green for 2 weeks? That should be your goal. That should be your goal for the next 2 weeks, is make one trade, be green. That psychology effect that will occur on you, you'll thank me later for that. Even if it's $5. If you're green by $5, just do it every day consistently, right? Stop trading when you're green. You get one green trade, stop. End of the day. Go sit on your hands, end the day. That has helped me more than you know, and it sure dang well help you. Now, let's dive into number 2, is the fallacy that you can diversify risk. Do me a small favor. Call up a stockbroker and ask them to define risk. I will be here till the next century because they're going to give you every single lame excuse, because here's the thing. They're not there to protect your money. They're there to make money for themselves. They will say they have a fiduciary responsibility, but they essentially don't. They're there to move your money from your pockets to their pockets. So they don't have a fundamental understanding of what risk is. A lot of people don't. And again, that is why it's so important for you guys to stay to the end for that critical tip that I'm going to give you at the end. And it will only take you 30 minutes to do. It's a fantastical tip. It's going to be huge. But again, why is that fallacy so ingrained in everyone? As you can see here on the screen, I have the sectors from yesterday. Can you please tell me what the problem is with this chart or this image? It's simply put that if you were diversifying away the risk, only one sector would be red. Only a couple sectors would be red. Not 70% of the sectors would be red. And also, I want to go back to this screen of my portfolio. I want Tasty Trade, amazing trading platform. I love them, right? Not plugging every single thing that I use, but I use Tasty Trade. I like them. I like their YouTube content as well. But they give you what's called a beta weighted average. What that originates from is essentially that it's weighed against the S&P. Why are all stocks weighted against the S&P? Because they all correlate to it. Name me one time when you've seen the stock market sell off and then you've seen a grouping of the Magnificent Seven, right? If tech wasn't selling off, let's say S&P crashed 10%, right? If truly it wasn't, diversification would protect you against risk, the heavy tech sector and the S&P would not correlate with one another. They correlate perfectly with one another, and that's why everyone looks at it, right? Simply put, they go like bonkers crazy together. They converge and diverge from time to time, but again, they basically go back and forth with one another. And also diversifying risk, and all these stockbrokers that claim that you could diversify away a risk, explain this one to me, which is basically that FRC. If all those that don't remember FRC, it's probably been pigeonholed out of your memories. FRC was when the banking sector, one bank, took the entire stock market down, guys. One bank, because of fear of contagion. If you could diversify away risk, explain to me why every single sector had a bloodbath that day. We were thinking it was the end of the world that day. Please throw in the comment section below what you thought of that day, right? Simply put, you can't diversify away risk. The only way to truly diversify risk is to put it in no risk assets and have high risk assets, and basically be the portfolio of 80% no risk assets and a high exposure of 20% to high risk assets. What are those assets? Bonds, short-term yielding bonds, because here's the thing. A bond, when it reaches maturity, will always pay you out. The government has a monopoly on violence. If the choice is between enacting violence and not paying you back, guess what? That government 10 out of 10 times is enacting violence. So again, I'm not saying that's right. I'm just saying how the world works. And simply put it, FRC is a perfect reminder of how the diversification lie continues to propagate the entire market. Even if we go to, let's say, the heat map, right? Another prime example. You have sectors are red, the sectors are green, but they all trend together. If we look at, let's say, a 6-month performance, where is the diversification lacking, right? You got small pitches of red in some places, but the overall, every single sector has a mountain of green. And therefore, guess what? It's not diversified. The only true diversification is if you went to something completely different asset classes. Bonds, VIX, and the stock market. There's your 3 asset classes. Bitcoin, in my opinion, is not an asset class. It's tied to the tech sector. It trends with the tech sector. It's the most risk-on asset. I know for all those that love Bitcoin are probably like keyboard warring in the comments right now. But then again, Bitcoin is not a true asset class. Crypto is just the same like tech. It's just going to be the same correlation to both of them. As crypto goes up, tech goes up, right? It's just how the world works. But again, I want to drill this into your heads, is that diversification is not going to solve your problem. People are told this lie over and over and over again, and they're told it because it makes them comfortable. It psychologically says it's okay. Just put your stuff in all these little sectors right here, and simply put, don't worry about the market turning down. Stocks only go up. Well, you know what I say to that? Go watch a weekend deep dive so you actually know if stocks are going to go up or not. Again, link down in the description below. That weekend deep dive will be down there along with the Discord, so make sure you guys check it out and join the Discord. You can ask me questions personally there, right? I'm open to all questions on Discord, so if you guys have more questions about this video, throw it down in the Discord below. But again, that fallacy of that you can everything is transitory, right? The only thing that's transitory, risk is not transitory. Inflation is not transitory. The only true thing that is transitory is luck. It goes from one person to the next, and you only get it really once. You only get lucky really once. You don't get consistently lucky. People that succeed in this market, right? They don't get lucky every single day. They have plans. And also, that's a perfect segue into number 3. So number 3 is not having a plan. And you may say, well, yeah, I had a plan. I was going to do X, Y, and Z. Well, did you write it down? Did you actually put the orders in to execute that plan? And did you set up your success for least barrier to entry? What does that mean, right? So when you're in the middle of a trade and you don't have those orders set up, are you going to magically remember to set them up? No, your emotion's going to take over. Mistake number 1 is going to take over, where you're going to let your head do all the dictating rather than having the orders pre-set up. And what do I mean by that? Simply put, it's something like this. This is a futures bracket order that I use all the time, and that is to basically set designated profit and stop losses on my entry. I have to click one button in order to set it all up, let the trade execute, and then I sit back. I go to sleep, ladies and gentlemen, and I either get stopped out or I make the trade. Guess what? I'm not up all night. I'm not thinking about it because I'm also position sizing correctly. First of all, you should never have your position be more than 2-3% of your portfolio. You should never allow yourself to take such a loss it's unrecoverable. Let's remember that for every 2% loss, we need a 4% gain to make back the difference, right? We don't have that capital. Oh, it'll recover is the biggest fallacy in existence, right? And as we can see here, you will look at a company like this. I've talked about Lumen on this channel till I'm blue in the face. Why do I talk about Lumen? Well, number one, I love all the trolls that are out there for this stock. And simply put, it exemplifies the fallacy as forever. And let me walk you through that, right? So if you look at this, fantastic, right? If you bought near the lows, you're up nearly 335%. You have the world on the stick, but you won't take profit. And there's other companies I'll go into just to give an example of people that literally had millions. And prime example, Dogecoin. There was a guy that had billions of dollars, went from literally $100 to billions of dollars overnight, never sold. Again, if you didn't sell, you didn't have a plan, guess what? You got nothing. Now that thing is worth back to nothing and the guy is back poor, right? So life-changing money, and literally it went all the way of the dinosaur. So why is the fallacy of not having a plan? Well, simply put, this is a prime example of a stock that basically everyone went into not having a plan, right? In the 1997, it had the dot-com bubble right here. And then subsequently, it basically traded for almost essentially a lost decade, almost 2 lost decades to be exact. For all those that don't know what a lost decade is basically when a stock trades sideways for a set period of time. Sideways can be pretty volatile in between. But this stock peaked out in 1999. We peaked out in 2007, right? No, shocking pattern here. And to this day, people will try justifying why this stock is a great buy. We peaked out in 2011. We peaked out in 2014. Subsequently, since 2014, this stock has devalued itself nearly from, let's say, the localized peak to current price, 84%, previously 97%. And people will still go into this not having a bloody idea what to do, how to execute, or even do anything. And there's more and more examples of stuff like this. If you trade penny stocks, which I don't recommend you do, I stay away from penny stocks as humanly far as possible. I know a lot of people on this channel like penny stocks. I don't know what you guys see in them, but then again, if you have a plan, congratulations, you can trade them. Thing is, I'm not sure how profitable that is. But regardless, I'm not here to judge about your profitability. I'm here to explain the fallacy that is not having a plan. The times that have gotten me in trouble is when I don't have a plan, I keep mashing the button on futures. That ends very, very poorly. Some of the worst trades I've had on futures is where I played a catalyst event with no bracket order. You can guess how fast that went horribly against me. So again, I'm trying to teach you guys the mistakes I already made so you don't make it. Have a plan, write it down, allocate small positions in your portfolio. Like we talked about in the Tasty Trade positions here, I only have about 0.05 allocated to every portfolio. But remember, risk number 2 is having everything that's correlated. So I look at this as the totality. I have less than 5% in my portfolio going into a catalyst event. I have cash on the side to play that. I don't put everything into options, number 1. I don't put everything into stocks. For example, Rumble, that is a tiny position. I have approximately on the stock, about 200 shares. That is $1,000. That is a minute proportion of my speculative investments that I'm putting into a company I believe. I also have options as a plan to counteract any downside risk. So with the stock, I'm only down $27 comparative to other people that are down way, way more. And I'm not necessarily dollar cost averaging. I'm rolling options, and I'll be talking more about options. But first, if you haven't mastered these 3 things, you can't get into options. That is simply options are emotions on steroids, so they crank it up to no end. So you really have to be careful of what you do with options because they can wreck your portfolio in a heartbeat. Now, I promised you guys 3 things at the end that you stayed to, and thank you all those that stayed to the very end. First of all, it's going to be, you need to read these 3 books. Each of them takes about 30 minutes on Audible to listen to. So you have plenty of time. If you're driving to work, get Audible and listen to books. It'll make you smarter and also teaches you about the markets. First book is Safe Haven by Mark Spitznagel. This turned my understanding of investing and risk management that I've discussed in those last part of the video upside down on its head. It revolutionized my world. I highly recommend it. Next, Nassim Taleb's 2 books, Black Swan and Skin in the Game. He talks about how financial sectors basically push all this narrative out there without having skin in the game. Skin in the Game really talks about how people act when they're in the markets and not in the markets, and how to spot tomfoolery where someone's trying to sell you a pig in a barrel. And also, his book about black swans is revolutionary in understanding what's going on in the market. When you read these books, you will literally be your eyes wide open. I highly recommend it. And also, if you would like a book that revolutionized my life, was Never Split the Difference by Chris Voss. It's not necessarily related to markets. However, it really changed my life, and I hope it changes yours. So thank you all so much for watching. At the end of this video, right over here, you should see the Weekend Deep Dive video link there for you to watch. Make sure you guys go check it out so you can see what levels you need to pay attention to in the market. And thank you again so much, and I hope to see you in the next one.